In this video, I'm going to talk a little bit about a couple of fundamental liquidity ratios. So for the ratios I'm going to talk about today, we have the current ratio and the quick ratio. So with the current ratio, we take the current assets at time t, so one particular point in time, and we divide it by the current liabilities at time t. So again, one point in time. And so what we're looking at there is those current assets we expect to be able to convert to cash within a year. The current liabilities are things we expect to have to pay within a year. And so basically, we're looking at our ability to pay the things that are coming due with the things that we expect to be able to convert to cash within a similar time frame. Now, that leads to kind of an obvious question. Could the current ratio be too low? Well, sure. If we don't have enough liquidity, we might have a hard time meeting our upcoming obligations. Could I have a current ratio that's too high? And I would argue that you might be able to. That's actually quite possibly true. This one's a little bit more subtle, though. The reasoning behind that is if you think about the kinds of things that are in current assets, we have things like cash, accounts receivable, inventories, marketable securities, and we don't really make much return on having those. Now, we need those. We recognize that we need a certain amount of cash. We recognize we probably are going to wind up selling on account in order to sell as much as we'd like to sell. We need inventory to sell the inventory. We make the money by selling the inventory, but we need to have inventory to sell it. So we need these different current assets. So they're necessary, but they're not really making money for us while we have them. So with current assets, it's sort of a fundamental tension of they're kind of unproductive assets, but we need at least some of them in order to function as a business. So from that perspective, with a current ratio, it could definitely be too low, right? I just don't have enough of these current assets on hand. But it can also be too high if you have too many assets that are sitting around and they're unproductive. So what constitutes the right amount is what gets interesting. Because basically, you have to look at the business and in the industry. So, for instance, if I'm looking at a company that is producing cereal, for instance, and sales are very stable and predictable throughout the year, very stable and predictable throughout the business cycle, in that case, they could perhaps have a current ratio that is below one, meaning they might even have, say, 70 cents of current assets for every $1 of current liabilities, and that may be completely fine. And the reason why that might be fine is even though they don't have enough current assets right now to pay off those current liabilities, the reality is the sales are so stable and the profits are predictable enough that they're going to have enough money available when each of those liabilities comes due. They're not going to have a problem paying them off. And so the idea there is they don't need to have $1 of current assets for every dollar of current liabilities on hand because we can count on and it's predictable what revenues are going to come in, what the profits are going to look like, and ultimately they can use some of those cash flows to pay off those current liabilities. On the other hand, if you were looking at a consumer cyclical company, maybe some kind of consumer electronics company or something like that, where product life cycles are very short, we're having to constantly produce and innovate new technologies and new features and things like that. And sales are subject to much more significant fluctuations. Consumers may not buy it in a recession. In this case, this is by no way, in no means as predictable and stable as that first scenario. And so in that case, we may want to have quite a bit more in current assets than we do in current liabilities, partially as a hedge against, a recession in which I just don't sell much at all. And so what constitutes an ideal ratio depends a lot on what company we're looking at. And even for companies in the same industry, it may be different. Because if we're selling maybe a product and we're targeting sort of a low-cost leadership segment of the market, a generic product, produce the lowest cost possible, we may not be as affected in a recession as compared to a high-end product that is more of a special item, more of a splurge purchase for the consumer, for instance. So even within a particular industry, the ideal ratio may differ for different companies depending upon what those target markets are. So now let's take a look at the quick ratio. A lot of that same logic applies to the quick ratio, but what we've done with the quick ratio is that we have removed inventory. So remember, current assets would include cash, accounts receivable, inventories, marketable securities, things like that. So inventories is on that list. So in that numerator, when I take current assets less inventories, what that actually means is I have removed inventories from the numerator. Inventories is no longer in the numerator of that formula at all. And so basically what we're looking at is how capable am I of paying those current liabilities that are coming due within a year with current assets that I think I can convert to cash within a year, excluding or ignoring inventory. In other words, if I don't count on selling anything, can I make this work out? Can I pay this off? And so from that standpoint, if you look at changes in inventory do not change the quick ratio. And the reason they don't change the quick ratio is because of the fact that I have removed inventory in that numerator. So changes in inventory do not change the quick ratio because the current assets had inventory in it, but then I subtract inventory. So really, if you work out the math there in that numerator, the quick ratio doesn't have inventory in the formula anymore. It's removed it. So inventory does not change the quick ratio. And again, could I have a quick ratio that's too low? Absolutely. I just don't have enough short-term assets available. Could I have a quick ratio that's too high? Probably so. You just have too much cash sitting around idle. It's not productive. That's not good. What's an ideal level? Depends on the company, depends on the circumstance. Now, this does bring up an important kind of point here. The quick ratio is always going to be lower than the current ratio because we've excluded inventory. The absolute highest the quick ratio could be would be if they're exactly equal, and that would only be possible if we had absolutely zero inventory. So if you have a firm that has absolutely zero inventory, the quick ratio and the current ratio would be identical. But if they've got any kind of inventory whatsoever in their current assets, the quick ratio is always going to be less than the current ratio. So if you calculated your current ratio and your quick ratio, and somehow you got a quick ratio that's higher than your current ratio, you've clearly done something wrong. Something has gone wrong in your calculation because that's not possible. So from that standpoint, the quick ratio is always going to be lower. So if I had a firm, maybe they're selling cereal and their quick ratio is 40 cents per dollar, or so 40 cents of current assets per dollar of current liabilities, their quick ratio is 0.4. So in that case, well, they might be fine. If they're selling cereal, sales are pretty predictable and stable, probably not a problem. If I had a consumer electronics company that had a 0.4 quick ratio, I'd be a lot more concerned because that is not nearly as stable as the sales of cereal and so forth. So again, you have to look at the company, you have to look at the context when evaluating those. But we could have ratios that are too low, we could have ratios that are too high. What is too high and what is too low depends on the company, depends on the industry. All right, hopefully this little introduction to fundamental liquidity ratios has been helpful. Thank you so much for watching. Have a great day.